Welcome to the Capital Playbook. My name is Charles Williams. I am the owner and managing member of Pioneer Realty Capital. And today we are absolutely pleased to have two incredible women with us, Miss Rachel Grunn and Miss Andrea Swick. I love that name, Miss Swick.
Thank you.
I think you guys are going to really enjoy the show today because we're going to present things from a perspective that many may not have seen or heard, and that's from the investing woman in commercial real estate. Now, I say that because this is a male-dominated industry, but we have two women here who have figured out a way to be successful in commercial real estate investing, and I'm certain you're going to be interested in their story, their background, and I'm also certain they're going to share some nuggets of information that if you are serious about commercial real estate, you're going to want to hear. But please join me in welcoming these two ladies, Rachel and Andrea. It's certainly a pleasure to have you with us today.
Thank you so much for having us. We're excited.
Thank you so much.
Yeah. So GoodGood Investing. That's an interesting name. So tell me about the GoodGood. How did you come up with that name?
Yeah, so really we wanted to one, think about something that was memorable, but two, it really comes from the idea of doing good to our investors and always having our investor at the top of our minds, and then also so good returns, right? And then good for our communities, because we want to do good by them. We want to bring them value. We want to give them all the amenities they need, and especially a great place to live. So
wow,
that's where it came from.
Okay, good investing. That makes sense. So now, how long have you guys been in business as GoodGood Investing?
For about a year now.
Yeah.
We
celebrating our anniversary.
We decided to partner December of last year.
Oh, wow. Well, happy
Not
anniversary.
2022, but 2021. Yeah.
Okay, right after the pandemic.
Yeah.
Those are a good time to come together and partner.
Yep. Yeah.
And so now you guys have a current portfolio or assets under management, 180 million or more, or somewhere around there.
Yes.
Yeah.
But you started out individually investing and kind of building your assets up. How did you get started? Rachel, I'll start with you. Since how long have you been investing in commercial real estate, and how did you get started?
So I've been investing in commercial real estate for nearly 10 years.
Oh, wow.
And I know I look young. I am young.
Mm-hmm.
But I come from a real estate investing family. So my parents have been investing in real estate for over 30 years. And they started out in the single family side. A lot of people do, right? They start out flipping homes, being landlords. And then at a certain point, they were like, I don't want to do this anymore. This is a ton of work. There has to be a better way. So they went on this quest to find passive ways to invest in real estate. And they found out about the syndication model of real estate investing. And that was about 10 years ago. And I have the background actually in high fashion modeling. So I
can see that.
Yes, comes with the territory. But so for 10 years, I was actually traveling the world. And I was living in Paris, London, Milan, Los Angeles, and New York City. So at 20 years old, I actually had disposable income, which not a lot of people in their early 20s do. All my friends were still in college, and I was out there in the real world making money. So as soon as I had disposable income, my parents were like, you have to start investing in real estate. And of course, I started out in the single family route. But then when my parents found out about commercial real estate investing 9 years ago, they said, Rachel, you have to get involved. And I did. And so I started out as a passive investor. And the deals overperformed projections. And I was hooked. It was amazing. It was entirely passive. Wasn't dealing with tenants, termites, toilets, construction, or contractors, which is great. And then during the pandemic, I decided to explore the more active side of commercial real estate investing. And then so my husband and I actually moved back to Dallas during the pandemic, started a family. And then as I got more involved on the active side of these syndications, that's when I met Andrea.
Oh, okay. Well, very good. So, Andrea, tell us about your background. How did you get started?
Yeah, I mean, I really didn't come from a real estate family. In fact, I was raised by a single mom who was trying to make mortgage. But she taught me that education was really important. So I got my degrees and I was in Silicon Valley working corporate America. And there really was like a lot of, money in that field, but not a lot of time. So we decided to move from California to Texas just to really get more family time, my husband and I. And so we left our corporate jobs. Well, with that move, we had some capital that we could deploy in investments. We didn't know where to start, though. So as an HGTV lover, I started with Chip and Joanna Gaines and got a flip in Waco.
Did you?
Thinking that I could make the drive from Dallas to Waco. And so my kids really did not love that idea, but we did. We ended up doing a couple flips and they were successful. But I was like, how many of these are we going to have to do to actually scale, right? I didn't want to work a full-time job anymore. I wanted to concentrate on family. And so this idea of putting our money to work for us instead of us working was this idea that I really was going after. So I did a lot of research. We got a long-term rental and some short-term rentals, but really landed on commercial real estate. And I just loved multifamily because of the scaling aspect. Like my mind just clicked where I could think about like, okay, for my long-term rental, when I increase the lease, after a year by $100, that's like $100. How many am I going to have to actually buy?
Right.
But like in multifamily, if I increase $100, that's times 200 in the apartment community. And it just clicked that was the way to go. So we also started off on the passive route because we had the capital. And we started just putting, some money in one apartment community. And it was really a leap of faith because we didn't know any, not a ton about it at that time. And then we're like, oh, okay, we see the returns. Let's put some more into another apartment community. And so we just kept growing in the different spaces, in the different apartment communities. And so what I loved was the diversification because we got to invest in multiple states across multiple apartment communities. And I'm like, I am hooked. I need to get on the general partnership side now.
All right, very good. So it's interesting. And this is a conversation on our show we've had lots of times, the difference between a passive investor and an active investor. What experiences did you have as a passive investor, versus that of an active investor? Just tell me what you think, what you've experienced as both. You've seen both sides of it.
Yeah, I mean, passive investor, no work. Like all I need to do is read a report on a monthly basis to see like how the asset is doing. And I can quickly scan a summary to figure that out. On the general partnership side, obviously a lot more involvement. Do you want to take that one?
Yeah. So, of course, as you know, on the GP side, there's a fire a day, and not literally, but not a literal apartment fire, but you're a firefighter professionally. Absolutely. And you're constantly having to, even though we do leverage third-party property management companies at all of our assets, we still have to manage those management companies. And so, whether you're asset managing yourself or you have a third-party asset management company doing that, it's work. And we love it. But of course, even for us, at the end of the day, the goal is to retire off of our passive income. Right. That's the goal. And so my parents were able to 2 years ago. They completely retired from their multifamily syndications, and they've never been active. They've only ever been passive investors, and that is the dream. The active side is you not only have to work, but you also have to have the credibility to gain a reputation with management companies, with brokers, with lenders. You can't just go out there as a single person and buy a $20 million building. You have to have a team, a trusted team, and a team with a track record.
Yeah, very good. So now, which do you like better, the passive side or the active side?
Passive. No-brainer.
So what made you decide to go on the active side?
Yeah, I really think it was just having this knowledge that I didn't know anything about, right? And I unlocked a way to multiply my money and a way to retire early. And I'm so passionate about sharing that. That's what made me want to be a general partner, is because I can start sharing that with whoever now, right? Whoever I come into contact with, I feel like an evangelist. Like, I love Jesus, but I also love multifamily, right?
Okay.
Like, there's like multiple. And what I love about it too, it's not only about creating wealth for ourselves, but like a true passion is giving back and like building God's kingdom. Like for me, you know, and I know for you, Rachel, as well, like we want to use our wealth for good. And I feel if other people are empowered, right, to build their wealth, like success is for them as well. They can turn around and also impact others and their community in a positive way.
Okay, very good.
Yeah.
What about you, Rachel? What made you decide to go on the active side? Was it the same thing?
It was similar, but like she said, the opportunity to provide my friends and family with opportunities as well was very appealing. And then also, to her point about the community impact element, is so important to us. And we did see it was missing from a lot of deals that we've seen from other sponsors. You know, like, where is the community impact angle? How can we not only be investing as investors, right, capital partners in this project, but also how can we also invest in the community, invest in the tenants, invest in the surrounding area, right? Whether it be like a flex space on site that we're using for after school lunches or for after school care, or during the summer for lunch programs, because a lot of people unfortunately can't afford to feed their kids during the summertime. Like, what are we doing where our investors can make money, but then at the same time we can also provide good? And so that as well, like having control over the management of the property was very appealing to me. And it's been awesome, and it's only going to go up from here.
Well, that's interesting, and that's an important point that where we talk about often on this show. You know, there's so many people who want to be involved with commercial real estate. Some take their little pile of money and go right into the active side, and you know, if they don't lose all their money and if they survive it, which is rare. If you go into, you know, right into the active side, you're going to experience a lot of pain.
Oh, yeah.
But if you do like you guys have done, you started out as passive investors.
Yeah.
And as a passive investor, you gained an education
Absolutely
on how it all worked. And then it seems like you guys had a mission that you wanted to fulfill, and that is to add value not only to your investors but also to the community.
That's right. And you know, also in this business, it's all about relationships. It's all about relationships. And as passive investors, we're also able to build that network really strong. And so I think that's helped us a ton in our transition to the active side of real estate, where we're able to leverage strategic partnerships, and we have trusted vendors that we know will perform and that trust us as well. So that's been huge.
Yeah, well, that's wonderful. So now you mentioned as an active investor, the GP on the deal, it's put you in a position to really benefit your family and friends, and to bring them into deals. You use a syndication model. Yeah. Tell us how that works.
How the syndication model works? Okay, yeah. So I like to describe syndication as essentially crowdfunding real estate. That's a really easy way to understand it. There are more nuances, of course. It's not the exact same as just crowdfunding, because our investors come on as capital partners in the project. And based on their capital contribution, they're awarded equity in the property. Now, we have like shares, so to speak. I mean, they're not shares because you're not investing in our company. You're investing actually in the property, and that's what differentiates us from a REIT, is that you are buying shares of this apartment building. So if we have a $13 million raise, one share is $1,000. So we're selling 13,000 shares in the property. If you're investing 100,000, you're buying 100 shares in the property. So that's how we're able to compute our investors' equity easily, is through our private placement memorandum, which I know you're familiar with, and these shares are called units, right?
Okay.
So exactly, you got it. And so that's the syndication model. It essentially allows people who otherwise wouldn't be able to own commercial real estate or real estate period, depending on their tax situation. I, for one, write off nearly all of my income on my tax return because I can. So for me, it's very difficult to qualify for a loan.
No, I'm joking.
Yeah, it's because I'm smart, okay?
Because you're smart. But continue.
But yeah, but I mean, listen, there aren't loopholes, there are incentives. And so I use the government incentives to mitigate my tax responsibility,
Right.
but that means I can't qualify for a loan.
Right.
So I couldn't buy a single family investment property if I wanted to. But I can still be a part owner in a $40 million syndication.
Isn't that interesting?
It's amazing.
Yeah.
So we're so passionate about educating about that because the syndication model is game changing for scaling your real estate portfolio.
Absolutely, yeah. So what is the minimum investment in your deals? You said 1,000, but it can't be 1,000.
No, it's 50 to 75.
No, it's 50 to 75. No, our shares are 1,000, but you have to buy at least 50 shares.
Okay, yeah, because that would be a headache. I tried that once. I had an offering with 5,000 was the minimum, and yeah,
not good.
Won't do that again. So that's interesting. And now, what was it like for you to grow your network of investors when you first started as an active investor? Was that difficult, or did you already have your substantial family and friends network that could come into your deals?
I found it so surprising. So I have a network of friends from Silicon Valley that get paid
a lot of money.
Really well.
Right.
And they have hefty 401ks. They are not the ones that are investing with us. They are very much stuck in a traditional mindset of 401k is the way that it is, but so we still are educating and, hopefully they will come through at some point. But, it's just a lot of education. The people that I didn't think would invest with us or had forgotten about, or it's friends of a friend, those are the people that are investing with us.
Yeah.
So it's almost the people that you don't even expect.
Yeah. I can relate to that.
And especially building, like you said, building our investor network, we've made it a mission of ours to lead with education because there's not much education out there on the subject because we were talking about before we started recording, there's a lot of rules and regulations regarding advertising in our business. And so for that reason, we don't have HGTV shows. We don't have this wide scale marketing of the product. And so we love to lead with education. And then with that, you just see this natural investor conversion because of course, who wouldn't be interested in something like this?
Yeah, very good. Well, tell us about some of your educational programs.
Yeah, glad you asked. So we have an email list, and when people sign up for our email, they get a whole couple weeks worth of educational material that we send to their inbox. And it'll be stuff like an actual deal example. If you invest $100,000, what is that actually going to look like year on year for returns? What does syndication mean? We have educational videos that we push out. And then we also have this really cool new tool called the 3-in-1 net worth assessment. You may be richer than you think because and I'm going to let Andrea talk about this as well because she has a very personal experience with it. And why we decided to create this net worth assessment is because people actually don't know what their net worth is. They actually don't know where they can tap into investable capital because it's more than just what's liquid in your bank account or your savings. You can invest in so many creative ways, especially in commercial real estate. Yeah,
no, exactly. And when we were going through this and creating this tool, I was looking at, okay, where is our money to figure out our net worth? Well, I had forgotten that, in Silicon Valley, you climb up the corporate ladder and you leave jobs and the 401k kind of just sits there. And I'd forgotten about this money that was in some 401ks. And so I had to look up the employer, look up who their 401k manager was in order to find that money. And it was a pretty penny. So I'm like, wow, I just found a lot of money. So I think if people can go through every single line item on our net worth assessment tool, they'll find money that they didn't even know that they had.
Yeah, and money you can tap into as well. And then we also have a section of that, and this just goes into the education as well, is we have a section on our net worth assessment tool. This is the 3-in-1, right? One part is finding out not only your current net worth, but you can also find out your future net worth based on your investments. And then also the second part is discovering your freedom number. In our business, what we call our freedom number is how much you need to retire, right? So how much do you need to make annually in passive income to retire from your active job.
Right.
So you're able to go through, and there's line items, there's memory joggers where you can write down like all the expenses you have in your life, and not just bare bones need to live, but want to have expenses as well in order to live a good life once you retire, right? And then once people discover their freedom number, then we determine your magic number. That's the third part of the 3-in-1 tool. And your magic number is how much you need to invest in order to get to your freedom number.
Gotcha.
Yeah. So based on the projected cash on cash elements of your deals, how much are you actually going to make, and how much do you need to invest to make that money in passive income?
Well,
and that'll be your beacon.
So now all these tools are no doubt on your website, right?
Yeah, for free.
Yeah, and then we also have a podcast as well.
Well, tell me about your podcast show. What's the what are you targeting on your podcast show? Is that educational, or what's the general subject matter of your?
Yeah, it is 100% focused on education and educating that investor that really doesn't know about multifamily and opening their eyes in a very simple way, digestible way. And we try to make it fun as well and not take ourselves too seriously. But just learning about multifamily and how do you do that, the ins and outs of a syndication model, what a general partner is, limited partner. We go through deals, we go through Q&A of, what an investor should ask their deal sponsors. So a lot of content out there.
Okay, very good. And that actually is a very, very important point because there are a lot of people who are becoming active real estate investors, and they're trying the syndication model. But it's really important to make sure you have the right sponsor. How would you define a suitable sponsor for a deal? What would be some of the key characteristics you would look for?
Yeah, I would say definitely someone who's conservative. So if you are looking at the deal itself, you want to look at their numbers and see, are they projecting rent increases to be 10%, 12% year after year? That's really high. That's something that will be too hard to sustain. So are they at like a 2% or a 3%? Like that's more manageable. But really going through that underwriting, I think will help you know if that deal sponsor is great or not. Also, like their track record, right? Do they have other properties under their belt that they've managed before? How much of an expert are they in that local area?
Yeah, exactly. And like she was saying about the conservativeness of the sponsor's underwriting, it's important even that passive investors have a baseline understanding of what a conservative underwrite looks like, so that they can make those informed decisions. And then, like she said, it's really important to know the sponsor's track record, because if they say that they've never had a deal go sour, they either have not been doing it long enough, or they're lying, and both are bad. So it is important to know, what deal has overperformed, what deal has underperformed, what have you done in those situations. So it's just really important to get to know your sponsor. You can ask for, it's very normal to ask for investor referrals as well. Talk to some of their investors that have invested with them, hear what they have to say. Communication is huge. Make sure you have a sponsor that communicates. That's what really sets us apart is you have our personal cell phone numbers. You can call us, text us. We'll get back to you in a very reasonable amount of time. So yeah, those are really important when looking for a sponsor.
Yeah, we do the same thing.
I love that.
I spend most of my evenings answering investor calls.
Yeah.
But that's fun. So what's really interesting to me is, and I can see it as I speak with you ladies, is your passion for that investor. Because as you mentioned, you don't have to be on the active side. You can get to your magic number just as a passive investor, as your parents did, right?
Right.
But because you're passionate about giving others an opportunity to invest in commercial real estate, that's why you decided to jump the fence and go over to the active side. And I think a lot of people don't realize it's not really easy for individual investors, one, to find the right GP or sponsor, and to have an opportunity to invest with them. Because one of the things that we're experiencing, as we were talking before, now as our assets grow, we now have more institutional investors that want to come in and invest with us, which kind of pushes out that individual investor. And we're having to fight to make sure we leave space for that individual investor. Have you guys experienced that?
Yes, certainly with the 35 sophisticated rule as well. Like we're only allowed 35 non-accredited investors per deal. Those spots fill up so
quickly,
fast.
yeah.
So we do run out of investor spots frequently. But not only that, I think another reason is a lot of sponsors either don't have the time, care, or bandwidth to educate.
Yeah.
And so when they have an investor that wants to invest, that's probably new, and is like, I want to give you $100,000, but I need to know more. And they, for some reason, can't provide or perform because maybe they have already a whole roster of seasoned investors that they don't have to educate. Then they might just say, listen, we're probably not the right project for you. And then that person's is left without an opportunity.
Yeah, yeah. And so that's why your platform works well. So now our environment has changed a little bit as GPs and sponsors. The Fed has decided to tackle inflation by raising our rates. How is that impacting you and the returns that you're able to offer to your investors?
Yeah, I mean, for some of the deals, we're just pausing cash flow because we want to make sure that we're conservative enough that we're not going to get into trouble.
Right.
And so the pausing of the cash flow makes sense. That's not something, the cash flow is nice in multifamily, but it's low, right? Like for us, it's the appreciation play.
Right.
So I think our investors, they're okay with it. They're okay pausing cash flow because they see what the economic environment is. And all of us would much rather be more cautious than aggressive anyway. So.
And as you know, a lot of times when we're closing on these commercial deals, sometimes our closing timeline is anywhere between 60 to 90 days. Now, an interest rate can change a lot in 60 to 90 days. So really what we're doing is also adding rate locks into our underwriting, finding out from our brokers or our lenders how much those would cost. Because I think right now a rate lock is worth it, even though it may be expensive to lock your rate for that long of a period of time. To lock it in at a sub 6 if you can, like that'll mean all the difference. It'll mean you can close on time. It'll mean you won't need to raise additional capital. It'll mean your returns won't change. So I think like just not exactly underwriting offensively, but underwriting defensively, thinking 12 steps ahead, preparing for the worst.
Absolutely. And, it's interesting for us, at least, because we have transitioning assets. And are you guys, when you buy, are you doing value add deals? Or
Yeah.
Okay. So you're experiencing the same thing.
Right.
When you go into a transitioning asset, oftentimes you're going to be using a bridge loan.
Exactly.
With a floating rate.
Exactly.
And it's interesting, 6 months ago I had a deal, my rate was 11%. The same deal, my rate's almost 15%.
Bridge debt is crazy. For a while, they actually even, like, some lenders were putting down pens on bridge debt because it was getting out of control.
Absolutely, yeah. And it makes it, of course, obviously, that devalues your property. Your rates go up, your cap rates go up. And so that means the value of your property go down. Now, with some of those transitioning assets that you had in your portfolio prior to the interest rate starting to jump up, how has that impacted the returns on that?
So I'll be honest. There's one deal that we have in Florida that has been really hit by, we have bridge debt on that asset. And it was shocking because we did close on the asset before, like back in April of last year, before there was like all this huge rate increase and rate hikes and all that. So yes, that asset, it was hit. However, we are projecting a 5 to 6 year hold. And so we are still super encouraged by the long-term trajectory of the asset. And we're very transparent about that with our investors. We're saying, listen, like this was a curveball we were not expecting, but this is how we're pivoting, right? So this is what we're doing with the rehab. And then this is what we're now projecting rents to be. And we're going to refinance as soon as possible to get out of this, floating debt rate, and then hopefully get into a more amortized loan that we can count on the rate being consistent. So we're still super encouraged. Of course, there's a million ways to skin a cat, and on most of our deals, we are constantly reevaluating our business plan, constantly reevaluating our strategy. You have to.
And what's really interesting, and it would again, I'm going to overuse the word interesting because my mind is spinning. But it's interesting that demand for housing is still extremely high.
Yeah.
But of course, with the interest rates going up, obviously, in order to make a profit, we have to pass some of that cost on. What do you think how do you think that's going to impact your projects in the future, year 2, 3, 4, and 5? Because you do have high demand, and you will have the ability to raise your rents a little bit, but not so much to cover, a 3% interest spread, right?
Yeah.
So what do you think is going to happen in the future here in the next 3 years?
Well, I think that it's, of course, in commercial real estate, value is based on income. Mm-hmm. So it's all about mitigating your expenses and finding ways to increase income. Mm-hmm. If, like you said, we reach a point where we really just can't push rents anymore to cover that, then we're going to have to mitigate expenses. So what does that look like? That looks like cleaning up property management expenses. That looks like billing back utilities. Or that looks like investing in markets where variable expenses, like right now we're getting killed by property insurance in a lot of markets. Yes. Absolutely murdered. Right. So what have we done? We just bought a property in Arizona where our insurance on that property was like $130 a door. Whereas we got quoted for a property in Louisiana at $3,000 a door.
My goodness.
So, but here, there's no claims in Arizona. There's no natural disasters in Arizona. So we're having to reevaluate the future of our business and acquisitions to mitigate those expenses so that we can still increase value even if maybe rents are maxed.
Now, another issue that many of us in the real estate development world or sponsors are facing would be labor costs and materials. And you would think because rates have gone up, some of the construction projects been put on hold, that would bring prices down. I personally haven't seen that. There's not only are they continue to be high, they still continue to rise. Yeah. How are you mitigating that risk as you go into a project?
So again, it's with if you have thoughts, please jump in. But again,
being conservative with our numbers and our underwriting. Like when we're estimating rehab costs, we're going to cushion it and put a little extra in that budget to account for those potential rising costs.
Right. Yeah. Even like a light rehab used to be like $3,500 to $5,000 a door. We're talking like maybe new countertops in the kitchen, backsplash appliances. Now it's like $11,000. Yeah. And that's just what we're having to underwrite. And and this is the thing, we look at probably 100, 200 deals before we even find one that pencils. That means one to even submit an LOI on. And then we got to hope our LOI gets accepted. Right. So it's not that every deal is going to work. Most of them aren't. Yeah. Most of them are not going to work, especially when we underwrite as conservatively as we do.
Now, there are sponsors out there who may not have the foresight and maybe are underwriting a little more aggressively. What do you think the future holds for them?
They're going to be selling their assets really like on fire sale. Right.
The bank will be selling their assets.
Yeah, exactly. Yeah. And we'll be buying them probably.
We'll be buying them. Yeah. Well, a lot of sponsors get paid acquisition fees, and they should. We do a ton of work, and we should get paid acquisition fees or however your fee structure is. GPs should be compensated. However, I think there's a lot of sponsors that, like you said, are underwriting aggressively and promising. We actually have an episode on our podcast called Don't Get Blinded by Projected Returns. Anyone can say anything's going to perform anyway. But the second you go in, like for instance, we were looking at a deal and it was projecting like 175% return. And we realized that their property taxes were off. Once we corrected that, it went to a negative 50% return.
Oh my goodness.
This is what I'm saying is like if someone's not crossing their T's and dotting their I's, it has serious implications for an investor. Serious. That's your money. And so I think these people are like making it to the bank right now on those acquisition fees, getting paid $800K for one closing, but then they're not going to have any repeat investors because all their deals are going to fail. Yeah. There's no way.
Yeah. And they just won't stay as long-term multifamily businesses, right? The ones that underwrote conservatively will have a great track record, a great career in multifamily, and they'll probably phase out really quickly here.
Yeah. And my concern is that that first-time investor who gets with the wrong GP or the wrong sponsor, because if they're a first-time investor, they probably don't know how to do the underwriting.
Right.
And they may not have someone they can rely on to look at this and say, hey, does this look right or not? So my concern is that person goes in with the wrong GP or sponsor, and then they lose everything or lose a big part of their money. The likelihood of them coming back and investing, in your syndication or my syndication is probably not going to be good.
Slow.
What do you think will have to happen? And I think what you guys are doing by providing this educational platform, I think it would help bring those folks back into the fold, because it is a great way to make money. I mean, we've all made pretty good money, good careers with commercial real estate, but a lot of people, I think a lot of people are going to be disappointed because we've seen 5 years of sloppy underwriting, and they've made money because we had low interest rates and there was high demand. We had a lot of people coming in and buy, so you can do a sloppy job of buying it, sloppy job of rehabbing it, and it's still going to sell. Well, now that's over.
Yeah.
So we're going to see a big adjustment here, and you guys are already preparing to snatch up some of these assets. Have you guys created a fund that gives you liquidity so you can work really quickly to buy some of these assets?
We've been talking about that.
It's in the works.
Yeah. So 2023, we are talking about starting a fund. Up until this point, it's just been raising on capital once we get the deal.
Right.
So.
Yeah. Well, I personally think there are going to be a lot of opportunities coming up in the next 18 months, and especially for those properties that were aggressively underwritten. They went out and found lenders that loaned at very high LTVs. They may have put PACE capital on top of that, so the thing's leveraged up to 95%. And now your rate's no longer, at 4%, you're at an 8% rate. Those deals are going to fail.
Yeah. True. But, and also in commercial real estate, you can get pretty creative with like assumable loans as well.
Mm-hmm.
So there's a thing called loan assumption, and you can actually assume the seller's existing interest rate. So if interest rates do become...
That's a very good point.
Yeah. So if interest rates do become a problem, you can always look for... and there's, not everything is perfect, right? There's risk to that and there's fees associated, but it might make financial sense to assume a loan versus to take out a new one.
Yeah. And so one, as you know, we're also lenders. And I see that as part of our strategy, not in assuming loans, but when you go and assume a loan, generally, if the value has come down, you're going to have to bring some equity into that deal. And that's where mezz lending comes in. And we see it as an opportunity. In fact, we have a fund that we've started where we're coming in as mezz lending so we can fill that gap between the primary loan. We come in as mezz and kind of help out that capital stack.
That's a great niche market. That's awesome.
Yeah, we've done it for a while, and it's worked out really well.
That's
for
fantastic.
us.
Yeah, it sounds like there'd be a huge need for it, too.
It's going to be a big need for it. So if you were to give your audience or our audience advice, if you would, summarize from both of your perspectives, a bit of advice that will help them grow their wealth, get involved with multifamily, find the right sponsor, what would it be? Let's start with you, Andrea.
Oh, you didn't give me a second to think about it. There's so many thoughts. I think one piece of advice would be really figure out how you want to build wealth, right? There is a way to build wealth on the active side where you can do things in single family like I did and start with fix and flips and do short-term rentals, long-term rentals. But if you're talking about building really big wealth, I would say look into commercial real estate. Really just get educated on it through your podcast, through ours. And I would say explore But don't overanalyze. There is always going to be a nugget of take a leap of faith.
Right.
And that's how I started. And it wasn't until we took the leap of faith that we have unlocked this just superpower of investing into multifamily. But you have to take action. You got to take that leap of faith to do it.
That's very good.
Exactly. Yeah. So what I would say is, like she said, you can get into analysis paralysis really easily, but it's so important to remember that a job will pay your bills. A business will make you rich, but your investments are what's going to make you wealthy. And I think people need to stop trying to become rich, but rather try to become wealthy, because that's where you are going to be creating generational wealth.
Right.
That's going to be able to help your children and their children, and you'll be able to actually teach your children things instead of just give them money, right? So I think it's really important that we flip our mindset and realize that wealth is for me, and commercial real estate investing is not only reserved for the super wealthy. It's not only reserved for the 1%. It's available for you, and it is a proven way to create generational wealth, and you have to take action. We want our investors to be so informed that they're excited and convicted about the action that they're taking, but you have to take action. So I think that's just like she said. I'm just going to echo that point. The best time to invest was 10 years ago, but the second best time is today.
I'll tell you what, it's going to get really, really good here in about 24 months. I can guarantee you that. Yeah. So Rachel Grunn and Andrea Swick. I'm so happy that you guys decided to join us here on the Capital Playbook, and I'm happy that you decided to join us, and I hope you found this information to be informative and beneficial. And if you did, do us a favor, make sure you click the like button on YouTube, and you subscribe so that you can be aware of the next shows that we have coming up. Ladies, thank you so much, and I really, really hope that you'll come back and see us again.
Thank you.
Thank you
so
so
fun.
much. Thank you.
Thank you.